Most people don't even realize what's coming. Michael Burry reveals shocking truth. The big short investor Michael Burry warns the stock market boom reminds him of the dot-com bubble and rings the alarm on options mania. Today we're going to talk all about what Michael Burry just said about the stock market bubble and what's going to happen. So watch the video till the end, because today's video is going to be the bomb. Welcome to Michael Burry Secrets, your daily dose of Michael Burry. If you're interested in everything around Burry, this is the place for you. Subscribe if you want to stay updated with all the Michael Burry secrets, predictions, and stay one step ahead in the financial world. Watch the video till the end, and make sure to hit the like button if you want to be a millionaire within the next 3 years. Don't forget to enable all notifications to join our weekly cash giveaway pinned in the comments. Now let's get to our topic. Michael Burry said the current market boom reminds him of the dot-com bubble, and compared the current options trading frenzy to the rampant speculation that precipitated the Great Depression, in a flurry of recent tweets that have since been deleted. The Scion Asset Management chief tweeted a screenshot of FinancialWeb.com's stock chart. The defunct company behind Stock Detective and other financial information websites saw its share price nosedive from a high of $28 to a fraction of a cent following the dot-com crash. A very common chart back in the day, Burry said, looks vaguely familiar. Moreover, the hedge fund manager compared the bull market during the 15 years to 2000 to the run-up in stocks over the past 15 years. He highlighted a 94% correlation between the Nasdaq's 100's performance in each of those periods, and a 95% correlation for the S&P 500 index. The Scion chief also drew a parallel between the surge in people trading options on meme stocks, such as AMC Entertainment, and the mass speculation that preceded the Wall Street crash of 1929. He juxtaposed an article about the options mania with a quote by a statistician named Leroy Peavy in November 1929. Peavy blamed the market crash that year on a wave of leveraged speculation that pulled in elevator boys, typewriter girls, and even school children. Burry is best known for predicting the collapse of the U.S. housing bubble in the mid-2000s, and making a fortune by betting on a spike in subprime mortgage defaults. His massive wager was chronicled in the book and the movie The Big Short. The investor also bought a stake in GameStop and wrote several letters to the video games retailers board in 2019, laying the groundwork for the short squeeze on the stock this year and the broader meme stock trend. He recently tweeted a picture of a subpoena he received from the Securities and Exchange Commission, ordering him to cooperate with the regulator's investigation into the GameStop saga. Burry has been sounding the alarm over Twitter for several months. He's warned dangerous levels of speculation in meme stocks, cryptocurrencies, and other assets will lead to the mother of all crashes. Scion was betting against Elon Musk's Tesla and Cathie Wood's ARK Invest as of June 30th. Veteran Professor Eric Gordon also outlines why he doesn't expect a stock market crash, calls Cathie Wood a dot-com throwback for her grand claims, and warns against owning meme stocks. The current stock market boom has shades of the dot-com bubble, but a crash isn't on the cards, Eric Gordon told Insider in a recent interview. Gordon, a professor at the University of Michigan's Ross School of Business, counts financial markets and technology commercialization among his research interests. He called out Cathie Wood for brushing off her critics, issued a stern warning to meme stock fans, and touted companies that can weather inflation as compelling investments right now. Stocks are more likely to drift downward than to plummet, Gordon told Insider. I don't think we're going to have a market crash, he said. Some stocks will crash because they're ridiculously overpriced, but for the market as a whole, we're likely to see a gradual stumble down. Strong corporate earnings across a wide range of industries, coupled with a robust U.S. economy, will help to shore up stocks even if sentiment turns, Gordon said. He also expects the Federal Reserve, assuming Jerome Powell remains chair, to gradually take the air out of markets and gently return equities closer to their historical valuations. Gordon drew a contrast between the current moment and the onset of the 2008 financial crisis, when the Fed faced an emergency situation and had to act quickly to shore up the banking system. The Fed has the luxury of time to adjust and then to readjust on this occasion, he said. However, he highlighted similarities between the hype around technology stocks during the dot-com bubble and the excitement around tech stocks today. While a couple of companies might go on to become the next Google or Amazon, he cautioned the majority could easily nosedive 90% in value or go bankrupt if market conditions change. If you are an investor, you had better be careful, he said. Gordon described Wood as a throwback to the dot-com era. The chief of ARK Invest is a champion of emerging technologies, such as electric vehicles and cryptocurrencies, and is banking on mass disruption and technological revolution in the coming years. He compared Wood's dismissal of skeptics, such as the big short investor Michael Burry and hedge fund billionaire John Paulson, to a common refrain heard from techies 20 years ago. "You don't understand. You're a dinosaur." Cathie Wood is the reincarnation of the zeitgeist of the dot-com era, Gordon said. He also suggested the fund manager knows the clock is ticking on her time in the spotlight, and accused her of making increasingly grand claims and aggressive predictions to drum up publicity. Investors should be ready for a period of grinding inflation and slower economic growth, Gordon said. He recommended they seek out companies that are well managed, in compelling industries, and can hike prices to maintain profits as their costs rise. The professor also cautioned against becoming a memester, as meme stocks are liable to tumble over time. "Those stocks would be very scary. I would stay away from those," he said. Recently, Michael Burry has been tweeting and deleting up a storm. In a recent flurry of tweets, he wrote the current market boom reminds him of the dot-com bubble. He compared the options trading frenzy to the rampant speculation that helped cause the Great Depression. These tweets have since been deleted, presumably by Burry. Burry also repeated his expectations related to index investing that he first presented openly 2 years ago. That is, index funds are in a bubble of sorts, as demand for weak companies is increased by the larger and stronger components. Meanwhile, there is little fundamental analysis to investing in indexes as opposed to individual stocks. Burry tweeted a link to a research paper dated June of 2021 about inelastic markets. The research demonstrated that the U.S. stock market's value rose by $5 for every $1 invested in it. The famous hedge fund manager that runs Scion Asset Management noted the majority of millennials use passive vehicles such as index funds to buy stocks. This could further stretch prices without proper evaluation. Burry wrote that 5-to-1 ratio will get much sillier in time, adding that the imbalance is a product of a paradigm. Again, related to the overall market, the hedge fund manager compared the bull market during the 15 years that led to 2000 to the growth in valuations in stocks over the past 15 years. He highlighted a 94% correlation between the NASDAQ 100's performance in each of those periods and a 95% correlation for the S&P 500 index. Michael Burry warned that the U.S. stock market is risky and accused the Federal Reserve of misleading investors. He said he was not investing in America's largest technology companies. The Scion founder and investment officer drew a parallel between the surge in people trading options on meme stocks and the widespread speculation that preceded the Wall Street crash of 1929. He showed parallels to an article about the options mania with a quote by a statistician named Leroy Peavy in November 1929. Peavy blamed the market crash that year on a wave of leveraged speculation that pulled in elevator boys, typewriter girls, and even school children. Well, that's it for today's video, guys. Also, we would like to mention that this is not a channel intended specifically to provide financial advice, and we do not ask you to invest in any company. This is merely a channel directed towards bringing educational content to your doorstep. With that in mind, before you invest in anything, we recommend you do thorough, wide-spectrum research on the topic. And make sure to subscribe and give us a thumbs up. See you next time on Michael Burry Secrets. Bye!